Hey guys, I'm Dave. This is smarthelping.com. We've got another addition to the template library here. I built an awesome financial model for a wind farm. We're talking about wind turbines, and this could be on land or on sea, either one. Plenty of robust assumptions to account for a wide range of scenarios. So what I'll do is go through each tab, explain how it works, and then you'll know how to use it. Download links in the description box. Um, Here we go. So first, company name, this just floats through to the top of the financial statements. Forecast period here, you just put the length you're forecasting for. So 60 months would be 5 years, 120 months is 10 years, that's the max. You can put in any amount of months here and the assumptions will adjust accordingly. Include terminal value, so the second or third assumption down here, no or yes. If no, then no value is counted. If yes, then you can put a multiple of EBITDA here and get a value. With wind turbines, usually, I was looking at useful lives, and typically 30 years is the length of time they'll last for. So since we're only running for 10 years max, you're probably going to want to include some kind of a multiplier here, and then that will flow through. You can see the terminal value here. EBITDA, trailing 12 months from month 120 is 23 million. Times 5x multiples 119 million value, and we're saying much of that might be going to assets. So here you can define how much is going to extraordinary income versus assets, and you can see on the Capex tab that's going to define your gain or loss here for those, since this is very capital expenditure intensive type of business. Okay, so next up, this is just cash sources, debt and equity, which you'll define elsewhere. There's a whole bunch of different loan types. We got 5 construction loan options for 5 different tranches, and then 2 operating loan options as well. So we'll go through all that, and then you could put tax rate here for regular income taxes versus long-term capital gains. Alrighty, next, deployment tab. So this is one of the main template or tabs you're going to be working in. So here you can label your tranches. So you can do up to 5 tranches, meaning you're deploying up to 5 sets of wind turbines. Either it could be in the same location or it could be 5 separate locations or what have you. What you could define for each tranche is the month number that they are deployed, the number of turbines deployed, the construction period, how long it lasts for in months, the average megawatt capacity per unit, and the cost per megawatt of capacity. And from my research, oftentimes when you're buying the actual materials and wind turbines themselves, they're priced based on the capacity you can get out of them. So, somewhere prices are going to vary, but let's say right now they're 1.25 million per megawatt of capacity. So you multiply those together, and this is the total cost for the turbines for each tranche. Now, you've also got lots of construction and development costs, so you possibly have to buy land, which you can enter here. If you're leasing the land, you can enter that assumption elsewhere on the OPEX tab, which we'll go through. Site prep, electrical infrastructure, project management, engineering, permitting, transportation and logistics, insurance during the construction period, uh, initial setup costs, training, um, and then total construction turbine costs here, percentage of total construction cost financed, amount financed, and then you can put in loan terms here. Now I did the type of construction loan I put in here is you can have it either be a regular P&I loan, or you can do a payment in kind, meaning that there's some interest only period where you pay an interest only rate, and then after that period you then go to a regular P&I amortization. Now, once if the business is exited and you are including a terminal value, any debt that's remaining will be assumed to be paid off, and that will affect cash flow accordingly. You can also turn the payment in kind off. So here on loan 1, I just turned it off. It's just a regular P&I loan, but if I were to put it on, you see now there's interest accrual, and then P&I starts down here, and this is just interest only for 11 months, or I could put it for 6 months, and then if I go back, see now it's only for 6 months. So this is all dynamic. We go to revenue. So there's essentially 3 income streams possible. The first 2 options are going to make up the majority of your income, which is either you sign power purchase agreements with larger utility companies or the government, and that says essentially you're going to stabilize your cash flows and they're going to pay you a set monthly amount, and there's some defined escalation in how much you get paid over time, and there's some contract length to that. In this case, we're only doing a max of 10 years. So what you can do is just enter your power purchase agreement, or if it is a power purchase agreement, you can select that, or if it's a wholesaler, you can select that. Those are the 2 types. Wholesaler is selling directly to the market, which is going to utilize all of these assumptions over here. The power purchase agreement is only going to analyze these. It's very simple, just a monthly payment for the electricity and escalation, annual escalation. So depending on what you select is going to define what actually flows through to the model. So here I've done every other one. So power purchase agreement, and then wholesaler. And if we look at the matrix here and look at the revenue, you can see we're doing wholesaler on tranche 2 and 4, so that revenue is there. And then we've got power purchase agreement happening here in 1 and 3 and 5. We just keep scrolling down. So that's all dynamic. It could be that they're all power purchase agreement. So if we selected that, went back to our matrix tab, you can see now everything's should be. Let me see what happened here. Oh, you gotta put in an amount. So let's say 500,000. Okay. There you go. So now you've got data for all these, and then the sale of the wholesaler is all zeroed out because we've entered 0 assumptions for those. However, for our variable costs, it could be relevant that we need to know how much megawatt hours we're producing. So that still is going to populate even if we're not using wholesaler pricing options for revenue. Okay, let me undo all of this. All right, so that was power purchase agreement. Now for the wholesaling, this is much more complicated. So this is if you're going to go out and sell your electricity directly to the open market. So you got to take into account a couple things. You've got seasonality here. So this is your capacity factor. And then based on the maximum capacity, which would be over here, and it's, if the megawatt hour, megawatts for the unit is 3, and there's 5 turbines, then your maximum possible capacity would be 15, which is impossible to get 100% capacity. Usually these things are like 30 to 40%, but it depends. The ones on the ocean are a little bit higher because the wind speed's more consistent. But that's the maximum megawatts. And then this defines in month 1 through 12 what the percentage of that maximum is that's attained. You've also got the max monthly production hours, because we're going to sell and price everything in megawatt hours. So how much you produce in megawatt hours per month times that price is going to give you your revenue. You could also define the average annual increase in megawatt hours, and then also the annual production degradation, meaning that efficiency and things go down as the turbines get older. And I've got a degradation table here. So you start at 100% in year 1. Based on this, let's say this was 1%, you can see that that top number adjusts, or if it was 5, it would adjust again. You can do different research, different things, like over a 10-year span. This is saying you're going to lose about 17% of the initial production. But again, that's going to depend on a bunch of factors, but you can account for it here. And then this degradation factor will apply dynamically to how much you're producing and selling your electricity for over time. There is no degradation factor on these contracts. These are just monthly payments with escalation. Okay, what else? What else here? I think that's it. Oh, I did want to say, so months 1 through 12, this doesn't have to be January, February, March. The whole model's built on monthly periods here. So these could be any fiscal period. So this could be, August, for example, and then starting in August, July, or sorry, August, September, October, going forward. And if that is the case, then on this deployment, you just want to make sure, or sorry, on the revenue, you want to make sure this month number represents the right month of your model, because this will be month 1 always. The first 12 months are going to be represented by that. So whatever those months are should be mapped to the actual fiscal month that it's being represented. And why these can vary per month is you could have different wind speeds in different times of the year, and that result in different capacity factors. Okay, so that's all adjustable for each tranche. Matrix tab is just doing all the calculations, so that's all dynamic and works. That'll pull through to the other monthly detail tab. Now, OPEX, you've got corporate overhead, so we can do a start month number for when these costs start. This is the monthly cost, which you can adjust in each year. And you can include just general operating costs here. Now, there's also direct costs, and there's direct costs based on tranches. So if you look here at this section, this is trying to figure out what are the direct costs per tranche. So 1 through 5, and then you could put in detail here for tranche 1, what's the expected monthly repairs and maintenance for the entire tranche 1? What's the environmental compliance, spare parts, land lease, insurance, property taxes, connection fees, monitoring systems, and you've got other slots here. So this can be detailed here, and then this total, whatever that is, right now it's 10,480, goes here for tranche 1 monthly costs, and then it goes up based on these percentages over time. So that's direct costs, but you've also got a couple other direct costs. We've got the option to do a cost per megawatt hour transmitted, and that can be variable. And any of these things that are not relevant, you can always zero out. We've also got other costs per month per turbine. So let's say you wanted, like this is doing an entire tranche monthly cost. Let's say you wanted to calculate it based on the turbine counts instead. Well, this gives you the option to account for up to 7 different types of costs per turbine per month, and then this total 2650 is going to apply to the total active turbines. So you can see the note here. So the total active turbines that exist at the end of a given month times this is going to be that cost. So there's a couple different ways to come up with your direct costs there. Capex, this is pulling directly from the construction for these 15 rows. So you got your top section is the turbines, which is, if we go to deployment, it's going to be this cost here. Then the next cost is your land, if any. And then the next cost is all the site work and infrastructure. So I separated it into these 3 sections. They all have different useful life options. So there's a lot of variability and flexibility here. And then you just have depreciation. The top row is for a fixed, like a building or something. If you're going to buy a building or what have you, you could enter its own cost basis, useful life, the month that's purchased, and then the value at sale. Now, what you'll do if you're using debt is the actual loan draw month for each of these loans for construction is going to correspond with when deployment starts, because that's what we're assuming these costs here are all going to be accounted for right up front. So you lay out the cash that you expect for the whole construction period, and then you also get a loan, and you can do it within 5 different tranches. Okay, staffing. I did tons of staffing slots. So this is, you can enter staff type detail, the start month of that staff type, the count of staff of that type, and the monthly cost, and then the increase of that over time, and if there's any payroll taxes and benefits to that. Now I did quite a bit here. We've got 250 slots for that. You could fill it in as needed, and these are just going to flow to the G&A general administrative costs on all the pro forma areas. Loan 1 through 5, we kind of already talked about it. These pick construction loans. These are just amortization schedules. The actual amounts getting paid are L and M. Loan 6 and 7 are just regular loans, so you can manually enter the financing amount and loan terms here. Cap table. So this is where the entire model will solve for the minimum equity investment needed based on all the different startup costs, construction costs, loans, everything else like that. And your total shares is an arbitrary number. And then I always just default to common, 100% common. And then in this section here, you've got two sections. You've got outside investors and inside investors, founders. So what you want to make sure is you can see that this is an auto solve, which is saying the project needs 26.4 million. So you can enter of that how much is coming from outside investors, how much of that's coming from inside. That should always add up to this total. This is a filler calculation overflow, so you don't have to manually calculate it if you're getting outside money. If it's all from owners, you could just copy this, paste values here, and then you can see that it zeroes out. You would want to zero out the equity and put this at 100 if that was the case. Also, some other ways you could use this, let's say you're going to raise 15 million from investors here. You're going to bring 2.5, and then you still have 8.9 million left. It has to come from somebody, and then you want to put in the percentage of share everyone's getting. So in this column plus this column should add up to 100%. So in this case, maybe we do 60, 20, 10 or something. And these percentages don't have to be directly proportional to this. It just depends on the different agreements or plans to agree. Usually people will just zero these out, put the have this be the remainder of whatever is not contributed by the owners, and just have it between the two totals here with the two lines. If it's not a joint venture, like I said, the first thing you could do is just copy this, paste values only into here, and then just put 100% for the equity and 0% here. Or you could do it, if you wanted to always auto solve, you could just zero this out, put this at 100, and that will just always be the initial investment and returns over time for the whole project. Here you can see 31% IRR. Okay, let me undo. There we go. We'll leave it at that for now. As you change the assumptions, the total equity required here will adjust, and then you want to come here and adjust the cap table accordingly. All right. So we move along here. Startup costs, these are just one-time costs that'll hit. Non-depreciable costs, if anything here, like consulting, whatever you might have reserve. Terminal value we already went over. Then we have the financial statement. So we've got income statement, we've got our three different revenues. Other income and credits. So we know where purchase agreement and wholesale revenue is coming from. That's the revenue tab. Other income and credits is actually going to come from the monthly detail. You can manually enter that. There's things like renewable energy certificates, government subsidies, and other ancillary services that are just manually entered here as a revenue item. So your different revenue, direct costs, gross margin, OPEX, corporate overheads, EBITDA, which is earnings before interest, tax, depreciation, amortization, interest expense, and this does include accrued interest, but you'll see on the cash flow statement that's added back, so we balance out on the balance sheet and we have the right debt liability amount. So interest, depreciation expense, taxable income, income taxes, and then net income. The income tax are just looking at if the annual period is taxable income is above zero. If so, there's a tax on that based on your tax rates. We go all the way over, we can see the exit value here was coming from extraordinary income versus sale of fixed assets. And that will again be based on this percentage here in terminal value against your Capex tab here. Okay, so there's income statement, balance sheet, looking at cash, non-current assets, accumulated depreciation, total assets, liabilities, which is all your different debts, loans that we configured, owner's equity, retained earnings, and then liabilities plus owner's equity always equals assets. So you can see this balance all the way through, and that will balance as you change all the assumptions in yellow across the sheet. All these automatically update. Cash flow statement, you got operating activities, investing activities, financing activities, and this is kind of like your sources and uses where you can see where all the cash is coming from each period. Okay, we have executive summary, so high level. This is kind of like the income statement, except for we're also showing other tax flow items here and getting all the way down to actual cash flow. Now you can see this checks out here because we don't have to do an interest accrual reconciliation. We just have the total debt service here and the total repayment of any loans is happening on the exit. But we're not looking at like interest expense up top here. This is just raw cash numbers, all revenues, costs, operating costs. So it's a little bit different than the income statement in that nature, but we're still getting to the correct cash flow per year. You've also got some charts over here. You've got an IRR of the project for the investor group and the owner group. Again, these numbers are arbitrary. I've just put in some random numbers for the assumption so you can see how it could work. Equity returned, cash returned, investor equity investment required, cash returned, your equity multiple, total ROI. You've also got a discounted cash flow analysis here, so you could put in your discount rate for the project, see what the net present value is. You could also do that for the investor side and the owner side. I always get people to ask what the discount rate should be. There's a whole bunch of different things you can do to figure that out. You could use weighted average cost of capital, capital asset pricing model. There's all kinds of different algorithms to look at. It's going to be industry specific and really essentially measure the risk of whatever you're investing in. Here, in this case, it's wind farms. We've got some nice visuals, so revenues, gross profit per year, EBITDA, cash flow. Let's put some labels on this. Gross profit percentage, EBITDA percentage, deployed versus active turbine count, monthly megawatt hour production, average monthly megawatt hour production per turbine, revenue per tranche for power purchase agreements, revenue per tranche for wholesaling, other revenue from ancillary sources, monthly cumulative cash flow, total assets versus liabilities, and then total assets versus liabilities annual view. And then monthly detail, this is where you can kind of see how everything's coming together by tranche, turbines deployed, active turbines, how much production you're getting, revenue from payment purchase agreements, or sorry, this should say power purchase agreements. Wholesale revenue, other income sources, total revenue. Here's all your different direct costs per tranche, other direct costs. Remember per total turbine count, and then cost per megawatt hour per transmitted. Total direct costs, gross profit, all your fixed expenses here. Staff count, EBITDA, your different loan proceeds, principal, interest, total loan proceeds, total principal and interest, debt service coverage. Now in the debt service coverage, we are not counting the accrued interest, since this is essentially a non-cash item. It's just accruing, and then we're paying it back with principal and interest over time as the loans are end their interest only period. So debt service coverage ratio, taking EBITDA against that debt service. We've got other cash flow items, your Capex, taxes, exit proceeds over 120 months, and then you've got a Capex detail. So here you can see where your costs are going for different Capex items. Since this is just one row here, I wanted to break it down to see. So this matches these totals, but you can see now what makes up each of these. And that's just based on the deployment tab. And here's a detail on accrued interest as well. And that's the whole model. The annual detail same as monthly, all the different things, and that has to always check out to be the same as the monthly and cash flow. And that's the model for you. So pretty good simulation here to understand the investments required and possible returns of starting a wind farm or multiple wind farms over time. This here, if you wanted to add tranches, you'd have to drag this down, drag the revenue tab down, and then adjust all these different logical references to account for that on the matrix tab and then the monthly detail, and just try to follow all the references. I am available for custom work as well. If you want to buy the template and then get some custom work, we can do that. No problem. I have a regular billing rate. What else? I guess that's about it. So I'm going to post the template if you want to download it it'll be under at smarthoming.com in the industry specific area. And I'll probably put it under, so wind farm, probably industrial. Let me see if I have any other better sections. Well, if I do, I plan on doing more like renewable energy stuff, like solar panels, um, maybe dams, something, I don't know, all kinds of different stuff. So I might have an entire renewable energy section when I'm done with this, but for now, I'll probably just put it in the industrial. So you can buy it individually, or you can just buy this whole industry specific bundle, and it will be included in that as well. And remember, guys, you can always check out, I do hundreds of these feasibility study templates. You can get everything, the whole library here. If you click on that for $9.99, and it includes every template I've built on the site as well as all future templates. And I've got a lot of stuff if you want to look at all the financial models here that I've done for different industries and different businesses. A lot of real estate stuff, a lot of membership subscription models, and then just industry specific stuff like I'm talking about now. Renewable energy will be a big part of what I'm doing going forward, so that's going to be fun. Joint venture, waterfalls, valuation, some accounting tools, just all kinds of stuff here that I've built over the years. Alrighty, that's all I got for you. Like and subscribe, and I'll see you on the next one.